Hello, this is Bob Chandler coming to you from Asset Protection Specialist. What we're about to talk about today should be on the front cover of the Wall Street Journal, on CNBC and Bloomberg. It should be debated all over the United States, all over the world. There's been a historic policy shift that has taken place. If you remember back in 08, 07, 08, and 09, you had heard the terminology bailout. And per Wikipedia, a bailout is a colloquial term for giving a loan to a company or country which faces serious financial difficulty or bankruptcy. It may also be used to allow a failing entity to fail gracefully without spreading contagion. So, by scrolling down here a little bit lower on the page, you'll see where Bear Stearns was the first company that was bailed out back in 08. Then Fannie Mae and Freddie Mac. Of course, these two organizations are the largest underwriters of mortgages here in America, which makes them the largest underwriter of mortgages in the world. Goldman Sachs was bailed out. Morgan Stanley was bailed out. American International Group, also known as AIG, an insurance company, was bailed out, and it was due to them being involved in the derivatives market. They had liabilities of over $1 trillion. Citigroup was bailed out. General Motors and Chrysler were bailed out. And you'll see here where Bank of America more or less bought out, let's just say bailed out Merrill Lynch. So during this 07 through 09 crisis, it was corporations that were insolvent. And now what we're seeing across the globe is it's sovereign nations that are insolvent. This is danger on a much larger scale than what we have seen up until this point. Okay, so you will see here, this is a letter, a paper, let's just say, that was written by the Bank of England as well as the FDIC, our own FDIC, a joint paper, and it was written in December 2012. So what we're going to do is just go through this executive summary here right quick. It won't take but just a minute. The financial crisis that began in 2007 has driven home the importance of an orderly resolution process for globally active, systematically important financial institutions. Let's just call them sci-fis. Given that challenge, the authorities of the United States and the United Kingdom have been working together to develop a resolution strategies that could be applied to their largest financial institutions. These strategies have been designed to enable large and complex cross-border firms to be resolved without threatening financial stability and without putting public funds at risk. So in the bailouts, that's what they did. They use more or less taxpayer money to prop up these corporations. This work has taken place in connection with the implementation of the G20. The joint planning has been productive and effective. It has enhanced the resolution planning process in both jurisdictions, tackled key issues in relation to cross-border coordination, and identify potential challenges that may be addressed through further work. This paper focuses on the application of top-down resolution strategies that involve a single resolution authority applying its power to the top of a financial group, that is, at the parent company level. The paper discusses how such a top-down strategy could be implemented for a U.S. or UK financial group in a cross-border context. In the U.S., the strategy has been developed in the context of powers provided by the Frank Dodd Wall Street Reform and Consumer Protection Act of 2010. Such a strategy would apply a single receivership at the top-tier holding company, assign losses to shareholders and unsecured creditors of the holding company, and transfer sound operating subsidiaries to a new solvent entity or entities. Reading between the lines here, this unsecured creditors are going to be bank depositors. So for instance, let's say that Bank of America gets in trouble, or Wells Fargo gets in trouble. In the past, what would happen is the government would step in and guarantee or make whole the depositors. They're getting away from that stance, and they're going to bail-ins, which we'll talk about further. Let's keep going here. In the UK, the strategy has been developed on a basis of powers provided by the UK Banking Act of 2009. So let's skip on down. Both the US and the UK approaches ensure continuity of all critical services performed by the operating firms, thereby reducing risk to financial stability. Both approaches ensure activities of the firm in the foreign jurisdictions in which it operates are unaffected, thereby minimizing risk to cross-border implementation. The unsecured debt holders, again, bank depositors, can expect that their claims will be written down to reflect any losses that shareholders cannot cover, with some convertibility or converted partially into equity in order to provide significant capital to return the sound business of the SIFI to the private sector operation. So what they're saying here is the bank deposits are going to be reduced that we have in our accounts, and they're going to give us in return shares in that bank or in that institution. Let's keep going. Sound subsidiaries would be kept open and operating, thereby limiting contagion effects and cross-border complications in both countries, whether during execution of the resolution or thereafter. Restructuring measures may be taken, especially in the parts of the businesses causing the distress, including shrinking those businesses, breaking them into smaller entities, and or liquidating or closing certain operations. Both approaches would be accompanied by the replacement of culpable senior management. So, if you remember back in 07 and 08, 09, a lot of these corporations that ran into trouble, the senior management remained in place. But under this new plan, that's no longer the case, that's obvious. If they ran the company in the ground the first time, there's no reason to believe why they won't run the company in the ground the second time. All right, so again, this was the Bank of England and our own FDIC. Next, we have the Bank of Canada. So I'm going to click back here. You'll see that we're on the Bank of Canada's website, and this headline here, Contingent Capital and Bail-in Debt, Tools for Bank Resolution. So when we click this PDF file, it pops up. Here it is. Now, we're not going to read every line, but let's hit some highlights. In the recent global financial crisis, many banks failed and or were in danger of doing so. Internationally, the public policy responses to failing banks differed substantially depending on the size and the complexity of the banks in question. Small, less complex banks were allowed to fail, and their failures were usually managed in accordance with existing procedures for liquidation and winding up. These failures resulted in shareholders being totally wiped out and the imposition of losses on debt holders and uninsured depositors based on established rules for creditor claim, seniority, and the resources available for the disposition of the failed banks. Let's keep going. Bear with me. In the cases of the failing large banks, the response typically involved public sector equity investment. So that's just the central banks across the globe stepping in and saying, hey, we're guaranteeing this company, or we're guaranteeing the assets. We'll increase the FDIC limit from 100,000 to 250,000, which is still in place today. That's just an example. Together with substantial liquidity support and credit guarantees. As a result, common shareholders of these major international banks generally suffered losses but were not wiped out, and preferred shareholders and creditors were protected. Here they are, they're just interfering with the free market system. Again, it's trying to purge itself of the fat. In addition to the managements of these banks, in some cases, they stayed in place. Estimates of the amount of public sector capital injections used to directly bail out major banks are well in excess of 100 trillion, including guarantees and insurance provided by major governments during the recent crisis adds up over 8.5 trillion. Now remember, in the prior posting that we did, we talked about, to go put into perspective how big a number a trillion is. To go back just a trillion seconds ago, we have to go back 32,000 years ago. Obviously, this debt will never be repaid. All right, so let's keep going. Public sector authorities were worried about exacerbating financial stress and wished to avoid the adverse consequences that could result from the failure of a large, complex financial institution. Authorities in many countries were concerned that they would not be able to resolve such institutions without causing a disruption in essential financial services and generating significant costs for the real economy. An implication of bailouts, however, is the creation of incentives that promote risk-taking behavior by the private sector. In other words, moral hazard. Over time, such behavior leads to a greater likelihood of bank failures, instability, and future crises with serious fiscal and social costs. Boy, it's not often that we truly get the truth out of these central banks, but the past few sentences have been just that. Let's keep going. As a result, policymakers have been reviewing their financial regulatory arrangements to develop a more effective ways to respond to the risk posed by large interconnected institutions. A wide range of approaches have been under discussion, including capital surcharges, systemic risk levies and funds, more effective supervision, contingent capital, and bail-in debt, improved legal powers to restructuring a failing bank, and living wills. So here's that word again, bail-in. Okay, so we're going to see here in a few more slides over how they've done that very thing in Cyprus. This is an outrage, and the storm that's headed our way could very well affect every one of us. All right, so here we are on the Board of Governors of the Federal Reserve website. This was a speech given by Jeremy Stein, who's a governor of the Federal Reserve, on April 17, 2013. We're going to scroll down here to this key paragraph. Perhaps more to the point, the too big to fail. If a sci-fi does fail, I have little doubt that the private investors will in fact bear the losses, even if it leads to an outcome that is messier and more costly to society than we would ideally like. Frank Dodd is very clear in saying that the Federal Reserve and other regulators cannot use their emergency authorities to bail out an individual failing institution. And as a member of the board, I am committed to following the letter of the law and the spirit of the law. So, like I told you at the beginning of this video, there has been a significant policy shift in how they're going to handle these crises that are going to be headed our way. Let's face it.